80%. That is not a normal premium. That is a market screaming that one price no longer fits reality. Here's the headline making the rounds. Japan pays $130 while COMEX prints $71 and bank shorts are imploding. If even half of that is true, this isn't just a silver story, it's a delivery story, a trust story, a system story. Because when the screen price and the real world price separate this hard, you're watching friction move through the supply chain. But we need to do this the grown-up way, because viral headlines mix three different worlds into one sentence: retail prices, wholesale physical flows, and futures reference pricing. If you don't separate those, you either panic for no reason or miss the signal when it actually matters. So in this episode, we were breaking down how an 80% premium shock can happen, how Japan could show 130 while the futures reference stays far lower, what that does and does not mean for global silver, and what shorts imploding would look like in real market behavior. Start with simple math. If spot is $71 and the all-in premium is roughly 80%, $71 times 1.8 lands around $128. Then add tax, import costs, fabrication, dealer margin, and you can see how $130 is possible without any global repricing at all. Possible does not mean systemic. It could be a retail crunch in small products. It could be a local currency effect. It could be a temporary bottleneck in fabrication. Or it could be something bigger, a wholesale dislocation that signals real tightness in deliverable metal. To understand which one it is, you need to understand a ladder of prices, because silver does not have one price. At the top, you have paper exposure pricing, fast and liquid, the number on your chart. Below that, you have wholesale physical pricing, large bars, institutional flows, where real supply and delivery matter. Below that, you have retail pricing, coins, and small bars, where premiums can explode fastest. Here's the rule. A retail premium spike is a warning. A wholesale premium spike is an alarm. Premium is simply the extra cost above the reference price to get actual metal delivered in the form you want, when you want it. Premium exists for normal reasons: fabrication, shipping, insurance, dealer margin, local taxes. But an 80% premium shock is not normal. That usually means one of three things. Supply is constrained in that region, demand is urgent in that region, or the product form is bottlenecked. Not all silver is equally accessible. A 1,000-ounce bar is not the same market as a 1-ounce coin. Wholesale can look calm while retail shelves go empty. That asks why comparing a retail shelf number in one country to a futures print can be misleading. It can still be meaningful, but you have to read it correctly. So the mission of this video is simple. We're not worshiping the $130 number. We're interrogating it. What product is it for? Is it one dealer or broad? Is it temporary or persistent? And most importantly, does it show up in wholesale behavior, delivery times, large bar availability, spreads, and settlement language? Because if the physical market is truly under stress, it doesn't just show up as a headline. It shows up as behavior. Let's build the Japan side of the story. Local markets are ecosystems, not spot plus a tiny fee. They have taxes, import rules, dealer inventory cycles, distribution networks, cultural demand patterns, and currency effects. So here are clean reasons Japan could show a shock premium without the global spot price moving much. First, product form. Most buyers are not importing 1,000-ounce bars. They're buying 1-ounce coins, 1-ounce bars, or smaller pieces. Those products are fabricated. Fabrication capacity is limited. When demand surges, fabrication becomes the choke point, and retail premiums can go vertical even if raw silver exists elsewhere. Second, dealer inventory. Dealers don't hold infinite stock. When buyers rush in, dealers protect themselves. They raise premiums, slow sales, ration, or stop quoting temporarily. That's risk management, not conspiracy, because in a fast market, a dealer can sell out at the old price and be unable to restock without taking a loss. Third, local taxes and fees. Even a moderate tax layered on top of a high premium can push an all-in number toward 130 quickly. Fourth, currency. If the local currency weakens, local metal prices can rise even if the USD spot price is flat. People often confuse currency weakness with metal strength. Fifth, shipping and import friction. If logistics slow or supply is tight globally, smaller markets feel it faster. Shelves go empty, and empty shelves create panic demand that feeds itself. Here's the key point. A local premium spike does not automatically mean the futures market is fake. It means the local market is stressed. What would make it a global story is persistence and spread. If Japan shows huge premiums for days or weeks and other regions begin showing similar stress, then you might be seeing broader physical tightening. If it's isolated and fades quickly, it's still a signal, but it's more likely retail only. Now let's address the COMEX number. COMEX is a futures reference. Futures reflect expectations, hedging flow, and financial positioning. It is not a retail shelf price. Comparing Japan retail to COMEX is like comparing bottled water at an airport to water in a warehouse. Same molecule, different market. But the gap starts to matter if it becomes persistent and unarbitrageable. In theory, huge gaps invite arbitrage. Buy where it's cheap, sell where it's expensive, and the gap closes. If the gap does not close, it means friction is blocking arbitrage. Regulations, logistics, time, product form, taxes, or settlement risk. In a stressed market, friction becomes the story. So the correct question isn't, is $130 real? The correct question is the gap persistent? And is it showing up in wholesale behavior? Because if wholesale starts paying huge premiums too, then the system feels it everywhere, not just on a dealer's shelf. Now we move to the heart of the system, delivery. This is where bank shorts imploding either becomes real or stays a meme. First, demystify what COMEX is built for. It's designed to provide a pricing and hedging mechanism. Most contracts are closed or rolled. A minority go to delivery. That's normal. The system works because not everyone asks for metal at the same time. A delivery spike changes the game. A delivery spike is not the same as trading volume. It is a rise in participants trying to convert paper exposure into real metal. That move is rare because it forces physical truth into a paper world. When delivery demand rises sharply, you get a stress test. Can the system deliver smoothly at scale, or does it start pushing people away from delivery through higher costs and alternative settlement terms? This is where people misuse inventory numbers. A warehouse can look full while deliverable supply is tight. The crucial concept is availability. Some metal may meet specs, but not be committed to delivery. Some metal is specifically registered and ready for delivery. In tight markets, what matters is how much metal can be mobilized quickly without paying a massive premium. Ownership is not availability. A vault can have metal that is allocated, not for sale, or in the wrong form factor, meaning time and cost are required to convert it. That is why in stressed markets, the deliverable pool can be tight, even if total inventory looks large. So what does shorts imploding really mean in mechanics? It means forced covering, margin pressure, rising cost to roll positions, and price behavior that reflects stress. But here's the nuance. Banks are not one thing. They can be market makers hedging flows. They can be running spreads. They can be short one month and long another. They can look gross short while being net flat. So the question isn't, are banks short? The question is the market being forced into delivery at a pace that breaks normal pricing? If the system is stressed, you'll see it through behaviors, delivery notices rising, deliverable categories tightening, spreads changing, quotes becoming less firm, and liquidity thinning. This is important because in real squeezes, liquidity disappears before price explodes. People think the first sign is a moon candle. Often the first sign is dealers widening spreads, saying call for price and extending delivery windows. Then premiums start to speak. Then the narrative shifts from price to access. The moment people ask, where can I get it? Instead of what is it trading at? The market is already in a new phase. Now let AS connect the 80% premium shock to a feedback loop that can turn a retail event into something bigger. If retail premiums surge, the story becomes silver is scarce. That story attracts more buyers. More buyers, empty shelves. Empty shelves push premiums higher. Premiums higher create more viral screenshots. That loop can create a retail crisis vibe, even when wholesale is only mildly tight. But retail loops matter because they can spill into wholesale through dealer restocking. Dealers don't magically refill shelves. They have to source product. If small products are scarce, dealers try to secure more blanks, more fabrication, more wholesale supply. That's how retail stress can start pulling on the wholesale layer. So here's the separating test. If the retail premium is a localized event, it usually collapses when supply catches up and fear cools. If it becomes systemic, you'll see stress creep upward into larger units. Large bar availability tightens. Delivery windows expand across products, not just coins. The language changes. Dealers become cautious. Spreads widen and quotes become less firm. Now we need to tackle the biggest misconception in the Japan 130th narrative. People assume that if one region shows a huge number, the true global price must immediately change. But in metals, the price that matters depends on what you're buying, exposure, wholesale bars, or retail products. A 1-ounce coin in a tight region can be priced radically above spot because you're paying for immediate availability, fabrication, and delivery certainty. Meanwhile, a futures reference can stay lower because it's still trading exposure and expectations. So when you see a massive gap, don't treat it as a scoreboard. Treat it as a stress indicator. The right question becomes, is this premium persistent and is it spreading? If it spreads, the system must reconcile it, and the only true reconciler is price. Price pulls metal out of hiding. Price motivates scrap. Price expands fabrication. Price reduces demand. That's why if the 80% premium shock is broad and sustained, the most likely outcome isn't instant apocalypse. It's a repricing process. Now, what about the claim bank shorts imploding now? Even if there is stress, markets rarely announce it. They manage it through terms. Margins can rise, spreads can widen, settlement incentives can shift, delivery can slow. Alternative settlement can quietly become more common. Those administrative changes are the warning signs, not a dramatic press release. So, to keep this channel credible, we anchor everything to a checklist of signals, not to headlines. Premiums elevated across multiple regions. Delivery times lengthening, not shrinking. Large bar availability tightening. Quotes becoming less firm. Persistent gaps that do not snap back quickly. If those signals cluster, you're watching real stress. If they don't, you're watching a loud retail episode. Now we map the 3 outcomes, because the audience needs a mental model for what happens next. Outcome 1, retail-only spike. Japan's $130 is mainly small product scarcity, dealer inventory, tax, and sudden retail demand. Supply catches up, premiums compress, and the gap shrinks. COMEX remains the anchor, and the internet moves on. Outcome 2, controlled repricing. Physical tightness is real enough that futures start rising, not because of memes, but because price must ration demand and attract supply. Premiums may stay elevated for a while, but the gap starts narrowing as the reference catches up. Fabrication expands where it can. Scrap responds. Demand cools at higher prices. This is the market healing through price. Outcome 3, dislocation. Premiums remain stubborn and broad. Delivery times keep extending. Large bar sourcing gets difficult. Settlement language shifts. Regional price gaps persist or widen. In this scenario, the futures reference loses authority as a delivery proxy. People begin treating it as an exposure price, not a deliverable truth. This is the psychological shift that creates legends, because once confidence breaks, the system becomes unstable. Now, it's important to say this clearly. Even dislocation does not require the world to run out of silver. It requires a ratio problem. Deliverable metal becomes scarce relative to claims at the moment demand for certainty rises. That's why delivery matters so much. A system can function with many claims as long as few people demand the asset. When demand for the asset rises, the system must respond through price, terms, or both. That's the whole mechanism behind paper versus physical. It's not a moral debate, it's a settlement debate. Now, your viewers will ask the same question every time. Can silver surpass gold? If they mean price per ounce, that would require an extreme regime shift. If they mean performance over a window, silver can outperform gold during spikes, because the silver market is smaller and more volatile. That volatility is why silver narratives feel apocalyptic. But fast spikes do not automatically mean permanent regime change. The disciplined approach is to watch behaviors, premiums, delivery times, availability, and persistence. That's it. That's the whole game. Now we finish with the viewer action plan and a clean human outro. If you want to follow this without being played by screenshots, stop staring at one candle. Charts can stay calm while the physical market is screaming. Instead, watch the friction indicators, premiums, delivery windows, availability language, and whether larger units tighten, not just coins. Then watch whether the story spreads. A single market can spike due to local factors. Multi-region persistence is different. If premiums remain elevated across regions and delivery windows expand broadly, that's deeper stress. Then watch whether institutions change behavior. Are quotes less firm? Are spreads wider? Are large orders harder to fill? In real stress, liquidity disappears before price moves violently. Finally, watch whether the gap remains unarbitrageable. If the gap closes quickly, it was localized retail stress. If the gap persists, friction is structural, and the system must reconcile it through repricing or rule changes. Now here is the comment prompt that turns this video into a global signal map and boosts engagement without sounding fake. If you're buying physical silver where you live, what premium are you seeing today and for which product? 1-ounce coins, small bars, or larger bars? Include your country. If this is real, the signal will cluster. If it's just noise, it won't. That's the difference between entertainment and evidence. And one last thing, because this channel is about mechanics, not hype. This is educational content, not financial advice. We're discussing how pricing fragments under stress and how delivery certainty gets repriced. Empires don't collapse from a single headline. They weaken when reality and the official story stop matching, and the system can't force people to accept the number on the screen. When that happens, the world starts paying for certainty. And in metals, certainty is delivery. If you want more breakdowns like this, subscribe to Money and Empires. And tell me which outcome you think we're heading toward. Retail-only spike, controlled repricing, or dislocation. Because whatever happens next, the mechanism is the same. When the reference price stops matching reality, the market reprices certainty first.